Hi, so I've been looking on the internet for a good explanation of what to look for in buying a house and all the whole process. And I didn't find anything that really explained it well. So I am going to try to explain everything as short as possible as I can. Now understand that buying a house is not always the best idea for you. I'll go through a few of the things that could be pros and cons, just things to keep in mind. People say it's the best investment after investing in yourself, but it's not always smart and depend. The cons are now you have a mortgage, you are liable and responsible to pay for a monthly payment. If you don't, you'll lose everything. If you miss a payment, that will lower your credit. Signing up for a loan lowers your credit. Everything will lower your credit in buying a house. But that's pretty obvious. You will not get back any closing costs or inspection fees or termite fees, termite inspections that you're going to do over the course of buying this house. Um, if you want to move, it'll cost you money. Everything will be done all over again. You'll have to close again. You'll have, agents, selling hassle, moving hassle. All these things are not that fun to do. If you're renting, you can leave whenever you want. You can find somewhere cheaper. You can stay by family, and you don't have to pay anymore. If you want to move to a different location, it's very easy. So that's much better about renting. If you rent, you don't have to fix anything that breaks. When you're buying a house, anything that breaks, you'll have to pay for it or fix it or do it yourself. You'll have more space to maintain in a house. If it's a bigger house, you'll have more space to maintain. It'll take more time to walk from one room to another room. Things won't be as close. I know that's not something that usually people think about, but when you have a one-level apartment, everything is close by. So, for someone that doesn't need extra space, it might not be worth it. Stairs are dangerous for babies and kids. Having one level makes it easier. Most houses, unless it's a ranch or 2 levels or basement or top floor, whatever, and you'll have stairs that you go down. Houses go up in value, so that's a good thing about a house. You're building equity, and if you live there long term, you're for sure saving money, and you have a bigger house to live in. When you're renting, usually you'll have parking that's not that great. Buying a house, usually you'll have parking that's a little bit closer. So there's a lot of things that you want to think about when you are buying a house. Now, as far as condos go, condos have a fee for a condo fee, but it also covers a lot of the repairs that you might have to do, and water, electricity, whatever it is. It goes in taxes. It goes into the taxes. Usually they're a bit cheaper than houses, usually less than 100,000 in Baltimore, and it's very spacious. Everything is on one level. Rooms are closer to each other, but there are no stairs, so that's less to maintain. So those are things that you might want to think about when switching from a house from an apartment to a house. Just know that you are putting yourself in liability now. You're going to be responsible and have to pay monthly, and that's the reason not to buy a house. Now, before buying a house, let's say you decide you want to buy a house. Look at your budget. Look at your bank accounts. How much money do you have? Set aside 3 to 6 months worth of expenses for a rainy day. Closing costs are around 10 to 15,000, so you have to keep that in mind. The rest can go towards your down payment, but make sure you have that amount before that. Now, how much is your down payment? We'll talk about that. The recommended to look for homes is looking for homes that cost no more than 3 to 5 times your annual household income. That's your first step. Just know your purchase limit, know how much you could spend, and in the months before, don't spend too much money on charges and credit cards because the lenders will analyze your bank statements and stuff like that. Move all your money into one account so that way all the money will be in the same place, and you want that account to be in the name of the person that's going to be borrowing the money. It will make the whole process a whole lot simpler. Make sure that the account is very secure. It's holding all your money for your down payment. So turn on two-step verification, things like that in this account. But have all your money in one account, and that account should be in the name of the borrower. If you have money in a random bank or investments or something that you plan on using for your down payment, take it out when you plan on looking for a house, because as soon as you want to buy, you're going to need that money, and sometimes it could take up to 3 weeks to take that money out and to be available in your bank account. So when you're applying for a loan, you don't want to be moving it around, so do it before you apply for the loan. So do it beforehand. That's going to be better for you. Get familiar with the wiring procedure on the account that you're planning on making the transfer from. On that one account that I told you to put your money in, that's the best place to wire the money from, and you should hope that it gets there for the same day transfer. And just get yourself familiar with it. Now you have pre-qualification or pre-mortgage for a loan. So I'm assuming you would want to get a loan. Most people get a loan unless they have cash. to pay for the entire property. So unless you have money to pay for it, you're going to need a loan. So find a good mortgage lender. Sam Rosenblatt is great. He was quick. He was always to the point, and he'll take good care of you. He did for us. You're basically going to tell them your income, give in your social security, bank information, your pay stubs, and you're going to start the loan process. If a spouse does not make money or has bad credit, put the mortgage loan just on the high credit spouse that has a job. You want the loan to not be on someone who has bad credit or no job. The title of the house can still be on both of the spouses, but I would recommend only getting a loan in the name of the spouse that has the money. But make sure that the money is in their account. Once they have your information, they'll run your credit. You'll be eligible for 90 to 100 days once they run your credit to create as many offers on houses as possible. I'll explain more about offers later. And after 90 or 120 days, they're going to pull your credit again to generate more offers, and that will lower your credit. So you want to try to, only pull whenever you want to make offers and try to, get your house in that 90-day period. When you're ready to make an offer, you can call them and ask them to prepare an offer for you, and they are going to actually send it directly to the seller of the house or the agent. They may not qualify you for a certain loan, for a certain offer on a house, depending on your financial situation. If you have a $400,000, house that you want to buy, and you want to borrow, let's say, whatever, $350, you have to be eligible for $350, and they might say no. They might say, sorry, the most we're going to lend you is, X and X amount. Now, how does getting a loan work? The whole process of getting a loan. Let's talk about that. So unless you have cash, you need a loan. Like I said before, you can either pay back in 15 or 30 years, every single month, whatever you can afford. 15 is better than 30. Obviously, we'll talk more about that. When getting a mortgage on a house, the mortgage or company or the bank, they kind of own part of your house, which means that if you don't pay, they take your house. That's what happens. That's called foreclosure. For the same reason, you pay them PITI, P-I-T-I, monthly. What is PITI? It's principal, interest, taxes, and insurance. That's your monthly payment. They don't trust you to take care of taxes and insurance. They want to make sure that they don't get stuck with the fallout of missing those payments, so they pay it for you. It's part of your mortgage payment that you pay monthly. If your house burns down, they don't want to be left with nothing, so therefore you pay to them. They pay to the insurance companies and government. The monthly payments are predetermined when you take out your loan. It only goes up and down based on your property tax. So if taxes go up, your mortgage goes up. Taxes go down, mortgage goes down. Taxes never go down, so don't expect that to happen. But your interest and principal will always stay the same and never change, which means that your earlier payments will be mostly interest, but as time goes on, you're going to be paying more towards the principal and less interest, but it's going to be the same payment. So even if the interest will go down and the principal goes up, until the loan is done, the payments are still going to be the same amount. The formula is very complicated, as the principal paid to pay on the interest changes every month because you pay a little bit of your principal every month. What is escrow that everyone talks about? After you purchase a house, the lender might establish an escrow account to pay for taxes and insurance. At the end of each year, the loaners will assess the taxes and costs and other costs and see if you need to add to the escrow. Escrow is basically an arrangement where the bank temporarily holds the homeowner's homeowner's funds until your loan is paid off to pay for insurance or taxes for that year or whatever it is. Also, escrow is used in a different setting. A good faith gesture to show the seller that you're serious in this house when you're making an offer. The interest rate, now we're going to talk about the interest rate a little bit. What is the interest rate? It's basically the amount of interest you are going to pay, the rate of interest you're going to pay on your loan. It will stay the same. Once you lock it in, it's going to stay the same unless you refinance. So for example, let's say you have a $100,000 loan at 4%, which means the first year you're going to be paying around 4% of interest with some principal. All right, that's what's going to be. Remember, as you pay each month, the principal is going down, so you're paying less interest every single month. Interest will be less of a percentage on the loan every single month. So basically, on the second month, you're only paying interest on $99,990 because you paid $10 of interest in the first month. $10 of principal the first month, and it goes lower and lower. A $100K loan over 30 years at 4%. So you have a $100,000 loan, 4% over 30 years is basically going to be $477. Your payments are going to be $477 monthly. That's the payment on your actual principal and interest, which means that the total amount that you will pay over the course of your entire loan at 4% of $100,000 is $71,000 of interest. So 4% is a pretty good rate. You're only paying $171,000 altogether on a $100,000 loan. 30 years over versus 15 years means that 15 will most likely give you a better interest rate. You'll pay off your loan much quicker because it's 15 years, but you'll also inevitably be paying less interest and more monthly principal. That's just the way it is. Now, as far as your down payment goes, your down payment is basically how much you're putting into the house, putting down on the house, and the rest you're going to borrow from the bank. So how much is your down payment going to be? So let's say you want to put down 20%. That is the best idea. So you have 20% versus 5%. The higher percentage you put down, the better your interest rate is because it's less risk for the bank, and it'll also lessen your monthly payments because you'll be paying less on the you'll be paying less principal. So mortgage companies will not accept less than 20% down on houses. That is the truth. They don't want a less than 20% rate. So if you want to put down 5%, how do you do that? The answer is that there's something called PMI. You could pay as low as 5% together with a required PMI, which is basically private mortgage insurance. What is PMI? PMI basically protects the lender, not you. If you stop making payments on your loan, they pay out. So they're basically banking on your paying your monthly payments, because if you don't, they have to pay, and then they penalize you. So you don't want to get into that. I would recommend just paying the 20%. It's much better, but if you don't have it, obviously, you have to do the PMI thing. Now, if you overpay on your mortgage, basically you're paying more than what you're required to monthly, it will go towards the principal. So even an extra $10 a month will go towards your principal. You could just overpay it. If you pay extra towards your mortgage, you're basically shaving time off of your mortgage. You're not going to lower your monthly payments, but you will shave time at the end. So let's say it's a 30-year loan and you pay, however much it is, you might be taking off a year, paying 29 years. The earlier in the loan you overpay, the better off you're going to be. For example, because you're going to be saving yourself paying interest on that money for the amount of the rest of your loan. So if you pay in the first year, you're basically saving yourself 29 more years of paying interest on that money. So let's say you have $100,000, let's say you have $100 extra in your first month, and you're paying at a 4% rate. It doesn't matter what the principal is. So in the first month, you pay off an extra $100 at 4%. So let's look at it. 4% over 30 years is $120, which is great. You're saving yourself $120, an extra $120 that you would have paid otherwise. And that works with $1,000. It's $1,200 at 4%. If you have a higher interest rate, you'll be paying even more. Now, what is a cosigner? If you can't afford a payment, but the bank, if you can afford the monthly payments, but the bank doesn't approve you because either they're not counting one of your jobs, or they don't count other things, or you have bad credit but you're making good money, whatever it is, you can have a family or friend co-sign for you and approve the loan. They will be responsible to pay if the buyer cannot pay. The co-signer cannot be taken off unless you refinance the loan. It will never take off. It will never come off your loan, at least for our mortgage company. And if you do refinance, remember you're going to lose your rate. So if you had a good rate, then you'll lose it, and also you'll have to pay for the refinance fee, and I'll explain more about that later. Now, what do you look for in a house? I would say the most important thing, obviously, is location to consider. Another thing that you want to think about is the condition of the house. Just look at how, what the condition is. There's going to be an inspection that we'll talk about, but you're going to want to look at the condition of the house. When you're just looking at the house to buy a house, that's something you want to look into. Also, long-term, if you want a long-term house, see if additions are possible. Do you want to make renovations or addition? Plan it out. See if it's possible. If it's something that's totally not possible, you may not want to buy the house. Where to, look for a house? How do you know what houses are available? So Zillow is a great place to look. Redfin also, but your best bet is your friends. The best deals always come from word of mouth. Look out for signs, talk to people, have friends and family look out for you, and that's the best way to figure out about a house. Now, when you use an agent to look for a house, they will look for the house specifications that you ask for. They'll help you through the entire process of buying a house, and they'll always be on your side, helping you with decisions. The seller must pay the agent 6% of the house total. So the agents, both agents. So if you have a buyer's agent and a seller's agent, 3% to each. If there's only one agent, even if it's the seller or the buyer, it doesn't matter, the 6% will go to the agent. Now, if you're not using an agent, if it's on sell by owner, there's no 6% charge. That means there's no seller agent or buyer agent. You'll basically the seller doesn't have to pay the 6%. And therefore, you can negotiate for a cheaper house. Even if the seller has an agent, you could still negotiate for a cheaper price because you could tell the agent, listen, if you want to sell the house, and I'm sure the agent wants to sell the house, you know, you'll forfeit part of your money, and therefore it will, I will be able to buy the house for a little bit cheaper, and that way they can negotiate it like that. I think that is a good tactic. Now, buying a house as is, if they're not selling the house, if they're selling the house as is, and that means they don't want to do any repairs before closing. No guarantee from the seller that everything is in working condition. If it's being sold regular as is, and if it's being sold regular and not as is, then you can negotiate if there's something that's broken. But as is, they're not going to really negotiate with you. They'll basically say anything that's broken, you have to fix. They may do repairs if you say you might back out, but as is usually means that they won't lower the price. They don't care if you back out. In regular situation, they may not care if you back out if there's something broken, but that's usually not the assumption taken. As is means they could just leave whatever is inside the house and you don't have to take care of it. They can leave a whole pile of clothes inside your house. They can leave beds, furniture, whatever they want, and you have to get rid of it. That is something that you have to keep in mind. Now, the next step in this after you make an offer is you negotiate an offer. When you want to negotiate an offer is, let's say you're buying a certain house. Let's say you look into a certain house. You look at the house and you like it, right? Now you want to buy the house, right? You find this certain house you like. You can offer the agent or the seller a certain amount, right? That's called putting in an offer or making an offer. You can make an offer by just telling them or texting them, or you can always send in a pre-qualification letter saying that you're pre-qualified on the house, and you can get your loaner agent to send an offer amount, and if you qualify for that house, have your agent send an offer amount. And that's usually better than actually just texting or telling him. Send in an official paper saying that that you are qualified on a loan on this house, and they will take you much more seriously than just telling them. You ask them to send the letter directly to the sellers, and then your offer is in. You can always make a lowball offer, meaning offer something that's worth it for you. If it's worth it for you to buy this house for this price, offer it. You don't have anything to lose. If the seller says no, no, but you'd be surprised what happens. You may even receive a counter offer and negotiate something. What's included in the offer will be in this offer the furniture, the appliances. Maybe you would want, a house, if it has a washer or dryer, you'll be willing to pay a little more. When you make an offer, the lender also adds an interest rate to the contract that is called locking in your rate. If the rate goes up, you're safe with that rate if you are locked in and you buy that house in the offer. Okay, so now the seller is going to, let's say, accept your offer. He might reject it, but if he accepts it, let's talk about that. Once your offer is accepted, the seller will sign the contract, and the basic contract has many things inside of it. What is this contract? It basically tells you the price, the closing date, the moving date, the seller, the buyer's name, what's included in the house, the price that depends on the inspection. The part of the contract says that the price will depend on the inspection, and there may need to be repairs or there may need to be a price adjustment. If there are damages, you can back out. That's one of the things that's in the contract. The seller is liable to fix termite problems that could be in the contract. Many other parameters about this contract, and you can read it, have your lawyer look at it. Some people also put a $10,000 good faith escrow fund to show that the sellers that you're serious. It's a good faith gesture. It's a good thing to do. Most people do it. It's going to go towards your down payment once you're closing on this house. This can be part of the contract, basically going towards the down payment. Now, if you back out, most likely you'll get this $10,000 back. Like, it won't go to the sellers. That's usually what happens, unless something that is completely your fault, and it then you might not be able to get this money back. At this point, you shouldn't be shifting any significant money in your bank accounts. The lender will ask for many documents, and make sure you're not going to do anything fishy. Don't buy expensive stuff. Don't have huge transfers in your bank. This even includes transferring from your own bank accounts. They want to know why you transferred it, where you transferred it, and why. The mortgage company will usually spend the time the next few days to make sure that your job is real, looking at all your paid stubs, determine if you're really qualified for the loan. They'll ask your banks for all your information, and they'll ask you for all your information about your statements and stuff like that. They might even look at your credit card statements and make sure that nothing is fishy. Now you'll have to get a title lawyer. What is a title lawyer? He makes all the title stuff that you need to deal with. He deals with that. What does that mean? What is all the title stuff? Well, you have title insurance, you have closing costs, you have transfer taxes, all this stuff. He takes care of it. He also takes the money that you put into escrow, the 10,000. He'll take care of all the things, all the money that needs to go to different places. Now, who would I recommend? There's someone called Jeff Silverberg. He's a very trustworthy guy. There's a guy named Lazar. He's very quick. He does everything very quickly. Larry London, I heard I know him. He's a very good guy. He has a very big firm, and Jeff Silverberg's place is called Esquire Title, by the way. Next thing that's going to happen is you're going to need an inspection of the house. You're not going to need it, but it's highly recommended. It's optional. If it's being sold as is, then you especially want to know how much money you're going to have to put into the house in order to live in it. Right? You're going to learn more about the home. The cost is usually between $400 and $800. Money you may not get back if you're backing out, so keep that in mind. If you have a general inspection done, then it's going to be very good for you to know what is going on with all the different places in your house. Now, in this house. Now, there are a few different places I'd recommend. There's a company called Highland, and there's a guy named Barry that does it. He did a really good job. He did it for us. There's also a guy named Crook. His name is Property Pros. Mike Bincino, American Inspection. These are all good people that I know from Baltimore. If they are actually good, they'll tell you everything that needs to be fixed, what needs replacing. They'll check the HVAC systems. That's AC, heat, water, boiler, heater, the sump pump, the roof, the furnace, the radon. If it's 4% or higher, the termites, mold, lead paint, environmental stuff. They'll also check flooding and if it's on a downhill foundation, and if the foundation's good. They also check for rodents, mice, rats, and for bed bugs. He will also check the piping. He won't check the piping. He didn't for us at least. Water doesn't usually go bad, but sewer does. So especially if you have trees by the sewer line, it could be that the sewer line is bad. That costs $3,000 to replace, and pretty often buying a new house, usually buying a older house may have that problem. Gas, I don't know about because Baltimore is actually replacing all of them. So that's actually very good for Baltimore people. The inspection takes about 4 hours on a regular size house. The one that he does, at least if he does a good job, they'll send you a report and you'll see everything in the report. They'll tell you all the things that are bad, all the things that needs fixing. And once you get that report, you can actually negotiate repairs or price or stuff like that. If the radon levels are high, the seller might even pay to fix that problem by installing a radon fan, or you may have to do it when you move in and you might negotiate the price. There might be termite problems, so get a termite inspection done as well. The inspection probably costs you under $100 around, but usually the buyer will pay for repairs if repairs must be done. Once that is all done, you may want to finalize the agreement. Once all the negotiations are done, credit repairs and seller and buyer credits and repairs are going to be done, and the buyer and seller will sign a new contract with the changes included. My agent told me that you can only negotiate about 3% of the value of the contract. Things should go smoother. Money credited will usually go towards the closing cost of the house. The seller agent always wants to show a higher sold cost, and therefore that won't be towards the sold cost. Instead, he'll just pay for the cost of closing. So that's something you want to keep in mind. Now, the next thing you want to deal with is insurance. The bank requires you to get insurance on your house if you want a loan. There's a minimum coverage required for your loan. Usually it has some basic things in it, like usually it will be like basic things. Everything is covered. Homeowners insurance generally only covers unexpected damages to your house. Now there's a lot of things that are involved in the insurance. It's a whole topic. There's something called a deductible. You can have a lower deductible, but then you'll have a higher monthly payment. Deductible means that if something does happen, an unexpected damage to your house, then you're going to have to pay the deductible. If the deductible is $1,000, you'll pay $1,000. They'll pay whatever rest of damages that there is. So that is also something you might want to keep in mind when you are getting insurance on your house. There's also a special sewer deductible and rate. So keep that in mind. You can also schedule things. If you have a gun, if you have insurance, if you have jewelry, if you have any type of art that costs a lot of money, you get those scheduled and you pay like $5 a month on a year on those, and those will be completely covered. No questions asked. I'll make you send the receipts and stuff, but the whole thing is a separate topic that will actually take a long time to talk about, so we will skip it for now. The next thing that's going to happen are the lenders are going to have the home appraised. That means the bank is going to come down and appraise to make sure that you paid the proper amount for your house. Now, if the appraisers see that you didn't pay the proper amount, then you're going to only get a loan on that amount, right? So if they find that the house is not worth the value you're paying, you have to pay the difference. Means if you want to buy a house for $125,000, 20% down is $25,000. You want to borrow $100,000, so you get $125,000. However, the bank appraises at $100,000 and say that you're only eligible for 80% of the house, which is $80,000. They will only lend you $80,000, and you have to pay the difference, which is $20,000. Basically, the appraisal lets all the parties know that they're paying a fair price on the house. So keep that in mind. You might need to borrow more. You might need to have more money, in your accounts to actually buy this house. Now, once that happens, you'll have paperwork. You'll receive a final loan approval. A lot of paperwork and coordination goes into getting this paper approved. You need a lot of titling work, seller, the rightful owner, repairs that need to be done, termites, radon, anything else that needs to be done. If the person getting the loan does not own, is not an owner on one of the accounts, you need a gift letter. What is a gift letter? You need the account number and the number of the amount that you're getting as a gift. You'll also need to actually send this amount in when you are wiring the money for closing. It has to be an exact amount that's listed on the gift letter, and it must be from that account. So keep that in mind. If you're borrowing from your parents or from a friend or something, they must actually send that amount in from the bank account that you specify on the gift letter. Then you are clear to close, right? Once they have verified all of your assets and everything is in order, the bank is ready to give you the loan and you are clear to close. They should also give you something called a closing disclosure. They call it a CD. And you and the cosigner, the loaner and the cosigner, will have to get it at least 3 days before closing, and you need to say that you got it and received it and sign it. If you don't get that, you can't close. It needs to be 3 days before. I think that's a law, and make sure you do that. But basically, there is the exact amount of the loan, and there's a lot of other information about your loan inside that closing disclosure. You can now move all your money around and get ready to move into the house, move the money out of the investments and other funds. Move all your money into one account so that you'll only pay for one wiring fee. Also move all the money to one account so that you'll have less hassle when transferring the money. Now, when you're wiring the money, you're basically sending your money to the title lawyer, but she will then transfer to all the people that need it. Most people that need it means the seller, but there's also taxes, title fees, transfer of taxes, mortgage, escrow, and all that fun stuff. He will take care of it. He will send you wire instructions, where you wire the money. He also may allow you to give him a cashier's check instead of a wire to avoid the wire charge, which is usually $25 to $35. Have all of your money in one account so that way you only have one wire charge. So that way you're not paying like $150 when you're wiring from 5 different accounts. Much better if it's all in one account. They say that wires take only a few minutes, but my research showed that it could take 2 to 3 days. So better safe than sorry, and transfer everything a few days before. Most wires require some sort of authentication. If you're a bank, it may be quicker, sometimes over the phone. If you are actually in the bank, it may be quicker. So whatever bank you're going into, it's probably better to go into the bank if you want to go quicker. Sometimes over the phone could be quicker, but Bank of America and Discover did not let me do over the phone at all. So just remember that you can only wire money after you are clear to close. Before you're clear to close, you should not be sending money anywhere, but afterwards you send it to your title lawyer. Closing only happens usually after 30 to 45 days from the time of your offer being accepted. Who goes there? The title lawyer, the agent, and the seller all gather and they sign. If there's a co-signer, they have to come to and sign as well. You will sign the paperwork required with the purchase, including the loan documents. It typically takes a couple of days for your loan to be funded and the paperwork to return to the lender. Make sure that at closing, everything left in the house either belongs to the buyer or at least establish what will be removed and when it will be removed. Once the seller gets their money, you can move in it is prudent to record everything that is said in the closing and signing. Now, you have taxes and house assessment. Basically, a city or county appraiser will come down and inspect the outside of your property once every 3 years to determine the property taxes you're going to have to pay. And the assessment goes up every time. By how much is only determined every year. So if you do renovations or buy a house, you're buying a house now. So taxes are most likely going to go up. The bank will charge you more at the end of the year. So since, meaning the mortgage bank will charge you more at the end of the year for your taxes because they see that your house got sold and they're going to charge you more. Since you recently bought a house, they're likely to come down and reevaluate it and base it on the price that you pay, and taxes will most likely go up. So property taxes, a city or county appraiser will come down and check your property every 3 years to determine the property tax. Now the assessment goes up every time they come down, but they only come every 3 years unless you do renovations or you buy a house. You are buying a house, therefore most likely taxes will increase. The bank will come down and the city will come down and check your house, and they'll say, well, you paid more for it, so taxes will go up. And then the bank will also charge you more at the end of the year and say, well, taxes went up, so we need to charge you more. So remember that it'll probably come out of escrow. If you get a permit to make any renovations or additions, your home will also be reassessed because your house may have gone up in value. They will charge you based on how much they assess the house for. It could be more or less than what you paid for it. So you can apply for a tax reduction though, based on your income. So that's one good thing that you can do. Also, there's something called a homestead, which means they can increase taxes by over 4% every year if you qualify. Also, they charge you less on property taxes, so it's worth looking into a homestead situation. Now, before you move in, you may want to clean the house for the satisfaction of knowing that everywhere is clean. And painting is also much easier with empty rooms. Take that into account. Change all the locks because the previous owner, still probably has some backup keys somewhere, and you don't want anyone coming in. Also, create a maintenance sheet. We got one from our inspector. He gave us a maintenance sheet, things that you need to do for a house. It was a very basic and general one. For example, you must get your lint trap, the lint dryer air thing but emptied every few months. And anything that needs fixing should be fixed in this time as well. It's probably much easier to do it when you're not home, and especially if there's lead or things like that you don't want to be home for, or asbestos. It's better to get those types of things fixed before you move in. Now, refinancing is a great thing to do if you're it's a great thing to do if you want to, for a lot of reasons. What's going on is basically you're swapping out your old loan for a new one. Down the line, you can refinance, and usually there's two reasons why people do it. Rate and term refinance. Basically, the rest of your mortgage is transformed into a new loan that has a better rate and or term for your situation. Or a cash out finance. You basically liquidate some of your home's equity, creating a new loan that consists of your previous mortgage balance plus cash you took out. Usually the first one is what people do because people want to try to get some better interest rates. So they get their interest rate down, you get a better rate, or they want to take a cosigner off and add someone else to the loan. They want to make their 30-year into 15 or 15-year into 30 to lower payments or to lower the amount of years to pay. Or if your credit score went up and you just want to get a better interest rate, a better rate. But remember, there is a cost to this. In order to make this refinancing thing happen, you need to complete a loan application and pay closing costs and bank and lender fees, appraisal fees, title insurance fees, and like your original mortgage, all those fees apply, and therefore it may not be worth it for you to refinance, but a lot of people do it. So I hope that helped you in making your house decisions.